Ladies and gentlemen, thank you, Mr. Garrett, for your kind introduction. In fact, yes, the good times are back again, and as you said, it's I think necessary role of the central banker to to close the the party when the party is warming up. You see it's warming up, but I think it would be too early to close the party because I think we are just now in a healthy situation of an economic recovery. What I want to point out here is, especially with euro area growth, that you see that one of the most important elements of the growth is a substantial increase in investment, which means that also potential growth for the future is getting strong. So I think this is a good message. We also, on the other hand, see that unemployment is getting substantially reduced. Also, one has to be quite aware that we do have, of course, still substantial differences between the countries of the Eurozone, between the countries of the EU, especially also with respect to unemployment, and we have countries with rates of youth unemployment still above 20%, 25% in one case, which is clearly something that is very, very delicate and very difficult to go about in the political side. And therefore, I share the view of quite a lot of observers that for the present time, the risks are not so much with regard to the economic situation, but more with regard to the political situation. And this is something to be taken seriously, and we know we have had some elections, we will have some elections this year in some important countries. That is, I think, the main risk perspective that we just have to look at. What we also see on the financial markets, that the spreads in the euro area are declining. This is part of the recovery. Of course, this is also due to the monetary policy of the European Central Bank. And perhaps it's quite important to be clear what is the view of the central bank with regard to interest rate spreads. We do not see the perspective that the long-term interest rate should be the same for all euro countries. What the ECB has been successfully avoiding is a situation where we have interest rates influenced by what has been called the redenomination risk. That means the risk that there might be a breakup of the Eurozone. This has vanished. So there's a clear signal, markets know the euro is there to stay. What it does not mean is that there should not be kind of taking an account of other kind of risks between countries. And so I think we want to have low interest rates, but we should be aware of distortions of interest rate structures. And this is, of course, something that always has to be also in the mind if we talk about interest rate spreads. You all know the policy of the European Central Bank. What you see here is, of course, the interest rate developments, and what you see here is that excess liquidity has increased remarkably. This had the effect of lowering interest rates. This was clearly one major element for the recovery of the Eurozone. Also, one has to be also aware, of course, the main reason for the recovery has been export-driven. And in that context, of course, also the exchange rate is something that has to be observed. Also, the exchange rate as such is not something that is part of the goals of the European Monetary Union, the ECB having a single goal, and that is price stability. So you see, we have here a development, and it's quite obvious that it would be very hard to think about extrapolating this for a very long future. So we will have to take decisions this year, but this is something where we still have some time to consider. For the countries of Central, Eastern, and Southeastern Europe, again, we saw the highest growth since 2008. So you see quite clearly the CEE countries are the growth zone of Europe. And this has become more visible in the last years again. And what is quite interesting is also on the right side, that if you compare economic output of 2016 with output of 2008, so that means at the crisis, and that you see that there are still a number of countries that where output is still below the crisis. So that means that there has been no real advance in these last years. So there was a deep loss that is still relevant. But as you see, the Eurozone as such has managed to get again above the crisis level. Austria a bit more than the Eurozone as such. And as you see here with the gray bar, the countries of Central, Eastern, Southeastern Europe are much more. So there has been a clear stronger impulse. And I think this is quite important to see, because this is not something that is a short-term phenomenon. It is based on long-term factors. So there is a kind of a stability in this development. Last point in my short presentation, what has been mentioned before. We as the Austrian Central Bank, since more than 10 years, we conduct a Euro survey. This is a survey of households in 10 countries, and also 6 of them EU member countries and 4 non-EU countries, where we collect information on household saving and borrowing, and also general economic sentiment. One of the aspects that are of very strong relevance for us here is both saving and borrowing in foreign currency. And again, we always have to stress, also the euro is a foreign currency for this region. It's not only Swiss franc, also the euro is a foreign currency with a potential exchange rate risk involved in it. And what we see here is, of course, that we see that the difference in interest rates between euro and local currencies has been declining. The question was, does this have any perspectives, any relevance for the demand in FX loans? And you could imagine that there is something like this. What we have seen is that this basically has not been very much the case. So you see that if we ask the share of households that are about to have deposits in foreign currency, this share is slowing down a bit, but not so much. And what is even more relevant is the issue, what is the share of households that are about, that want to take out a foreign currency loan within the next year. And here we see that we have very different developments in the different countries. We would have expected that also this share of households that are interested in taking out foreign currency loans would decrease because, again, the interest rate differential is increasing, which is not the case. And what we have taken out of this Euro survey is that one main reason is that in a number of countries we had public relief measures for borrowers, so that obviously there might be some kind of a speculative perspective that even if you take this risk, somebody else will have to carry on with the risk, which is a bit of a very, very kind of difficult attitude. Also, and in this context, of course, it's even more interesting to see whether the banks are following this. And according to our latest numbers, I'm glad to say that they are not following this. So that means we have a demand side, which is obviously very open for FX borrowing, but we have a supply side where banks have been rather disciplined. And so the FX share in loans to households has fallen significantly in a number of countries. Hungary, of course, from 2011 to 2017, from 70% to 3%. In Hungary, also, as you see here, the population has reacted to that. But for instance, also in a country like Serbia, from about 70% to 48%. So banks have been disciplined. They know about the risks of lending in foreign currency. And I have to say, we as the Austrian Central Bank, we strongly advise the Austrian banks active in this region to be extremely restrictive with lending in foreign currency. And which means, on the other hand, to work to get as attractive as possible savings opportunities in local currency. And because we have to be aware that there is not only the danger of a currency mismatch, there is also a danger of an overly extension of term mismatch. And this is clearly a challenge for the banking industry in this region. And of course, all this would not be a problem if we would have a perspective that extension of the Eurozone would be something that would come very fast. And then, of course, all these problems vanish. But I think all in this room have a very realistic view that it will take a long time till membership of the Eurozone can be extended to the countries of this region, or to most of the countries of this region. And long time really maybe mean a very long time. So that means this idea that there is some kind of an automatic solution for the problem of FX lending is a very dangerous idea. I'm glad to say that the banking community has learned this lesson, so that we do see increased discipline. But of course, we see some countries where still FX lending plays a very big role, even if it is a smaller role. This is one of a message I wanted to ship to this audience, because I know that there are quite a number of important decision makers here in this room for this context. And I think it is very important, because we have to be aware that we have very good and positive times just now. But we have to be aware that we have to use these good times to lay very stable foundations for the future. And therefore to have, to de-risk our financing systems is an absolute priority for all of us. I think both for us as the central banks, but also, of course, for those active in commercial banks. So this is a message I wanted to share with you. And thank you for giving me the chance to talk about this. And as you said before, of course, I'm also prepared to take some questions. Thank you very much.
Thank you very much indeed, Governor Nowotny. If I could just ask you first question, I wouldn't want to try to tempt you into putting a date on it, but when you say, when you talk of Eurozone accession as being a very long time, you emphasize a very long time, could I just ask you to say if by very long time you mean more than 10 years away?
Well, you know, it's always very tricky to...
10 years is not a very long time for most of us.
To talk about exact numbers of years. I think it's more important to be aware about the way of thinking. And there is something that I think all of us have learned. We know we have some formal criteria, the Maastricht criteria, for admission to the Eurozone. But we have all learned that there is one aspect that has been perhaps a bit neglected in the past. And this is the aspect of economic sustainability. So it cannot be enough to fulfill the Maastricht criteria for 1 or 2 years. You have to have a perspective, how long and how stable this is. And that means that you have also to take into account or to give a stronger role to the real economy factors, which are neglected in the Maastricht criteria. So GDP per capita, unemployment rates are all not relevant for the Maastricht criteria. But as we have learned, for practical developments, they are very much relevant. So this is kind of the issue. Also, to be quite frank, one has to be aware that at the end of the day, it is a political decision. And we know of countries where admission had been a political decision, and ECB was a bit skeptical about it. But of course, in this process, ECB, especially if it goes to ERM2, has of course a role to play. And this is something that I think is very important. We at the ECB, each year we have what's called a Convergence Report. And this is of course then a convergence that is not only on the criteria on the Maastricht criteria, but on a broader range.
Wider economic.
And I think this is, I think, the substantial answer to your question.
Okay, I take that as more than 10 years.
Well,
no, please, I'm not putting words into the governor's mouth. Nobody reports that. Central Bank Governor of Austria.
As you have seen in the former charter, of course, we do have higher growth rates in this region. So we have, it is the growth region of Europe. But on the other hand, we have had, of course, a period of time when convergence more or less came to a stop. So it's very difficult to predict.
I guess what you're warning against is people who've taken euro loans thinking that joining the Eurozone will simply take those out, rather like the 35% or something of Americans who I saw in a poll recently, when asked what their plan for retirement was to win the lottery.
Yeah, but this is part of the game. Yeah.
A question from the audience.
Thank you. Thank you for this very rich in breadth and depth presentation. I'd like to focus on one point that you mentioned in passing, and I think you gave it a short shrift, the excess liquidity. You said we have to do something about it. Do you think that we are in a period of inexorably rising excess liquidity? I suppose when you said we'll do something about it, you meant central banks bring it inside and then reserve the right to throw it back into the private market when the time is convenient, as it happened with several QEs and so on. Do you think we are in a period of inexorably rising excess liquidity and therefore inexorably low interest rates, simply because the world has enough real investment of the kind of refineries and steel mills and so on, and what happens now does not really require substantial investment. I mean, Sony, a 100-year-old brand, top 5 in the world, has a market cap of, employs 60,000 people, market cap 16 billion, WhatsApp 90 billion, 50 people. Facebook, market cap, I don't know, several hundred, 400. It took maybe a couple of billion to set up, to invest. So do you think we're in a world where there's no need for real bricks and mortars investment, and therefore there will be more and more excess liquidity, and therefore interest rates are going to stay low? The only thing that will happen with liquidity is it comes inside the central banks or out. Thank you.
Yeah, thank you for this very interesting question, because it is connected with a number of discussions that central banks and economic researchers have worldwide. The first aspect is, what tendency do we have to expect with regard to long-term interest rates? And as you mentioned, we may have big structural changes in the economy, where investment becomes much less capital intensive, so there's less brick and mortar, which means that also the need for investment financing becomes less relevant. On the other hand, where we still have maybe also due to problems or to aspects of an aging society, an increase in savings, so that the relative role of supply and demand shifts in the way of what Ben Bernanke had called the savings glut, an oversupply of savings, which means that we would have a tendency of lower interest rates, irrespective of the policy of central banks. So that this is market driven. And I do think that is a very relevant, important argument. Of course, so that we have to expect long-term lower interest rates. The question is, how low? And here, of course, central banks do play a role, because even if it's low, there might be a difference between 1% plus and 1% minus. So that therefore, I think we have a kind of a market-based tendency of lower interest rates. We have, of course, also an influence of central banks. And here we really have to be careful that we have a beneficial influence. That means that it really helps for investing, that it helps for liquidity in the markets, but that it does not lead to distortions. And this is something we are very careful about. You know that we at the ECB, we have this opportunity for banks to deposit liquidity with the ECB at a negative interest rates. And this is to an amount of almost a trillion euro. So there is, of course, the question again, why do banks deposit such huge amounts of money with negative interest rates? And there is no such a clear-cut explanation. One, of course, would be to see this, that there is still a certain uneasiness international in markets, because you can interpret this negative interest rate as a premium for safety. You see this very clearly in Switzerland. Switzerland has a negative interest rate of 0.7, also minus 0.7. So this is since many years. So and so also for the Eurozone, you could see this as a certain kind of premium to avoid risk. The question is, what kind of risks? Is there still some kind of unknowns in the market? It might be that it is something that, and what we see is there is, of course, an increase tendency for liquidity, both in the banking industry, but also in the real economy. So the real economy, and I think this is one of the lasting effects, perhaps, of the big economic crisis, that the real economy industry has substantially increased the propensity for liquidity. And this, one of the reasons is because many enterprises have learned that if there really is a crisis, they cannot rely on the banks. They don't want to be at the risk that when they really need it desperately, banks are not prepared to provide the liquidity. So this is a reason that is very strong. We have at the European Central Bank, and I have at the Austrian Central Bank, we have regularly contacts with the real world industry, and this is still something that's very strong. The same holds to a certain extent also with regard to countries, because what we see is also that currency reserves have been increasing on a worldwide scale. And as a governor of the Austrian Central Bank, I am also governor of the BIS, the Bank of International Settlements. And I remember at one of our meetings, so this is a worldwide meeting, and at one of our meetings, there was a discussion about what is the correct size of currency reserves. And of course, there was, let's say, the academics' view, too many currency reserves means that you just forgive consumption opportunities. So your welfare would be better off to use this for imports than to increase your currency reserves. And one of the governor of an Asian country said that all may be true, but we still have learned our lesson from the Asian crisis. And all we want to do is, excuse me if I'm that open, all we have, our top priority is never to get the IMF in again. Because this is quite, so this is, means that you are losing part of your economic sovereignty. If the IMF hopefully was there, because otherwise we would have had a worse crisis. But to avoid needing an IMF program is, I think, given all the history that we have, a very relevant topic. So you see, I think this, in some way, this long-lasting effect of former crisis all leads to an increase in demand in liquidity. So therefore, I think these numbers that we have shown have to be interpreted not in a static way, but more in a dynamic way.
Governor Nowotny, thank you very, very much indeed for that very detailed, very interesting answer. The Asian insight you bring there is an interesting one. We should all put our money in the teapot and put it under the bed.